Hello and welcome to Stock Value Tips. In recent years, T-Mobile has clearly outperformed both Verizon and AT&T, and there are several key reasons behind this success. First, T-Mobile built the strongest 5G network in the US, especially in mid-band spectrum, which offers the best balance between speed and coverage. Second, T-Mobile has delivered consistent subscriber growth, while Verizon and AT&T have struggled to grow meaningfully in a saturated market. Third, T-Mobile's simple pricing and customer-friendly plans helped it attract price-sensitive consumers without sacrificing network quality. Most importantly, T-Mobile follows a focused, wireless-only strategy. Unlike AT&T and Verizon, it avoided distractions such as media acquisitions or legacy cable businesses, allowing management to concentrate fully on execution. As a result, T-Mobile achieved faster growth, better margins, and superior stock performance compared to its peers. While T-Mobile executed well, Verizon and AT&T made several strategic mistakes that held them back. AT&T spent years investing in media and entertainment assets, such as DirecTV and Warner Media, which distracted management and destroyed shareholder value. Verizon also struggled with slower 5G execution, focusing heavily on expensive spectrum purchases that delayed network rollout and pressured cash flows. Both companies relied on complex pricing structures and heavy promotions, which hurt customer satisfaction and made it harder to compete with T-Mobile's simple offers. In addition, capital allocation decisions at AT&T and Verizon were less efficient, resulting in higher debt levels and weaker long-term returns. Together, these factors explain why T-Mobile has emerged as the clear winner in the US telecom race. Although T-Mobile, Verizon, and AT&T have roughly similar debt levels, how they use that debt differs significantly. T-Mobile leverages its borrowing to fuel expansion, innovate, and gain market share, showing high efficiency in debt usage. Verizon keeps debt under control and avoids risk, but slower growth means the borrowed capital is only moderately effective. AT&T, burdened by large past acquisitions, has debt that generates less return, making it the least efficient in using capital to grow the business. Takeaway: debt alone isn't bad, it's about how strategically a company uses it. T-Mobile shows the best use of leverage, AT&T the worst, and Verizon sits in the middle. Here we can see the gross margins of the companies. They are quite similar, which indicates that the cost structure of providing telecom services is comparable across the board. Net income margins are also in a similar range, showing that overall, each company converts revenue to profit at a roughly similar rate. This slide is useful to understand that despite differences in size or strategy, the core profitability of their operations is relatively aligned. Looking at the overall picture, Verizon stands out for offering the best dividend and financial stability, though its potential for future growth is more limited. T-Mobile, on the other hand, shows the highest growth potential, fueled by aggressive expansion and strategic use of debt. AT&T sits somewhere in the middle. While it is stabilizing and paying dividends, the company is still managing the legacy of past acquisitions, which slightly limits growth. We'd love to hear from you. If you want us to do more comparisons of telecom metrics or other industries, leave a comment below and let us know what you'd like to see next. Don't forget to like this video if you found it useful.